talk about algorithmic trading and financial data analysis, what do we really mean? So we have, this is actually from our course. This is the learning management system we have, and this is like a roadmap that basically outlines what are the modules that goes into building an automated trading system. So of course, like the first step is to set up your environment, your development environment, and install the libraries that you need for doing algorithmic trading. And in algorithmic trading, basically in a nutshell, the way I would describe it is like, think about the transactions that we do on the internet, which is like lots of transactions. Basically, people will buy a product or an asset when the price is low and sell it when the price is high, okay? So we do this manually. So the idea of algorithmic trading is to automate that. Automate it in two ways. One way is to help us identify when would be the good entry point into the market, and the other one would be when it would be a good exit point. And then also, once we develop a particular strategy, we want to be able to backtest it. So as I mentioned, step one is to set up the environment. Step two is to collect data, because all the algorithms that we are going to develop for financial data analysis will rely heavily on live data that's coming typically from exchanges. And I like, personally, I'm a data scientist, and I like financial markets in general because data is available pretty much for free. So you can get as much data as you want. Like, let's say if you are interested in crypto, you can get pretty much all the data for all the major cryptos for free, down to the second or even millisecond level. So that's an interesting thought there. And so you can take that data, you can collect it, and then you can basically use it to build your own candles if you want, like the time frames, whatever time frames you are interested to trade in, whether it's 1 minute or 1 hour or 1 day or 1 week. So once we capture the data and store it on a particular storage, it can be on the cloud too. Then we need to do some kind of data analysis to be able to analyze the data. And they're going to show you examples of these things as we go through the process. So data analysis, basically, you want to be able to look at historically at some data. You want to do some plots to see some correlations and relationships between different assets. If you are trading, or if you want to trade like a full portfolio, you want to, for instance, to pick assets that we can help you to have a diversified portfolio. And then the next step would be to connect to a broker. And if you are trading crypto, that would be like a crypto exchange. If you are trading Forex, that would be like a Forex broker, or maybe you know, a stockbroker or something like that, so that you can you'll be able to execute transactions, basically to buy and sell assets within that particular using the API that the broker would normally provide. So of course, the biggest part of it is the strategy definition, right? So the question is, how do we define a successful strategy that will enable us to that will enable us to identify when is a good time to get in the market and when is a good time to exit the market. And even if we have a very successful strategy, we also need to think about risk management, right? So risk management is this idea that you know, we all hope that things go our way, but the reality is that in financial markets, lots of external factors could actually influence you know, the price, and the market could go against us. So the question here would be like, what would be our risk management? And then finally, like once we create this bot, because imagine with me for a moment, so if we build this system, so basically you are going to give it access to funds, right? Funds that could be on maybe an exchange or broker, so it would have access to your wallet. In cryptocurrencies, we like to call them like crypto wallets that would be usually on the exchange. So those transactions have to be definitely secure. So you want to make sure that that security is an important aspect of what we are doing here. And also we want to make sure that the system is available all the time, because one of the major problems that could happen is that if you open a position, in other words, you buy assets, and then all of a sudden there is an opportunity to sell and make a profit, but all of a sudden the connection or the internet connection is down, then that's a problem, right? So we want to make sure that the system also is available. That's why it's always recommended to deploy this type of systems on the cloud. And then, so that's the thing. And then after that, after we execute all these transactions, we want to take a step back to analyze our trading performance and then try to tune our strategy. So like most of the people, when they build like a trading strategy, they think, okay, yeah, I had it, but it didn't work. But actually there was one step that I noticed that's missing from some of the courses that I have been able to deliver in terms of algo trading, is that less time is spent on tuning the strategy. Developing a strategy is good, but we also need to tune it so that it can be more profitable. But what I want to do today is I'm going to show you a couple of examples from this program so you have an idea a little bit about the process. So I'm going to start talking a little bit about data analysis, scraping data from an exchange, and I'm going to do a little bit of backtesting of a particular strategy. Yeah. And then finally, I'm going to show you like a live bot that's actually running on the cloud. Yeah. All right. So that's the program for this session. So let me go ahead and start first with the financial data analysis module. And so I want to just take a little bit of time to go through this. I just also want to talk a little bit about the prerequisites. Yes, this module has a prerequisite, which is that the participants, they need to know Python or maybe some other programming language, but you have to have some experience with programming. If you don't like and you want to take it, we have programs like we have one program called AI or Data Science Professional Program that covers the prerequisites for this. But again, so here what we want to do is we want to go to, as I mentioned, crypto data is available for free. So here, let's say we are considering 3 assets: Ethereum, Bitcoin, and Matic. And these are just cryptocurrencies against the US dollar. And we want to ask some specific questions. Like, let's say we go back 1 year ago and we spend certain amount of money on each one of these assets. And I want to know what's the value of my investment today. Yeah. I also want to know if I want to put a portfolio together, I only want to buy 2 of these assets. Which 2 should I buy? Should I buy Ethereum and Bitcoin? Or should I buy Matic and Bitcoin? Or what combination should I put together so that I can have like a diversified portfolio? Yeah. So let's go ahead and get started. So the first thing what we want to do is collect data. So here what I will do is I want to collect data for 1 year, and the time frame that we are going to use, it's going to be 1 day time frame. You can also collect data per hour or per minute, whatever time frame you feel comfortable with. So here what I'm going to do is I'm going to go to Yahoo Finance and I'm going to basically collect data for these 3 assets and store this data in files locally, yeah, for analysis. And then I will be, then what I'll do here is I want to load it into data frames. So here we will have the opportunity to look at the data. So for instance, so here I'm just looking at the end. This is today. The price is around 73 cents. That's the open price, and then that's the close price as of for this particular day. Yeah, and then the crypto market, it's actually open 24 hours. So it opens at midnight UTC time and it closes at 11:59 UTC time. Yeah. Yeah, and then also you can look at Ethereum, and then here what we want to do is we want to just plot and have an idea about like the performance of this asset over a particular period of time. One of the cool things about Python is you can build interactive plots. So you notice this is not static. So like back in April 2023, the price of Ethereum was around 1,842. And then this is where we are today. It's around 3,157. Yeah. Okay. You can also look at the volume. So for instance, I might be interested to look at the trading volume for Bitcoin. So trading volume will give us a clear indication about how much interest there is in a particular asset. So notice during the period where we are, there is like a low volume. So, usually if it's a consistently low volume, you can expect the price to go down. In other words, if less and less people are interested in a particular crypto or asset, well, it can maybe resist for a little bit of time, but eventually the price will go down. Yeah. And maybe that could be an opportunity to buy. Yeah. So I'll just continue the discussion here. I'm just trying to find out a little bit, just wanted to know if I have any missing data. So notice we have, for this data set, for Ethereum, we have 365 rows. And then for all the columns, the open, the high, the low, the close, the adjusted close and volume, we don't have any missing data because I see here in each one of these columns, 365 values. Okay. Now now we have the data, then we can start thinking about putting together a trading strategy. So here I'm going to use one of the simplest ones actually in the course. We cover some pretty advanced strategies, but this is just a simple one for demonstration. It's called MA cross strategy. So here I'm going to be looking at a period of 20 days and 50 days and calculate like a moving average and compare that against the actual price, the close price for that asset. So when you do that, this is what you actually see. So here you have the 20-day moving average, then you have the 50-day moving average, and then the orange is actually the price. We're looking at Ethereum here. So how can we use this strategy? Well, there is like a simple idea that if the 20-day moving average is above the 50 right here, maybe that's a good opportunity to buy. Notice here when the blue line crosses the green line, the price of Ethereum is around 1,000. It's around 1,629. And then when it crosses again the blue line is below the green line at 2,342. That's maybe a good time to sell. And you can see an opportunity right here also, if you can open a position again here for Ethereum at 2,399 and then close it here at 3,463. Now, I'm sure that some of you are looking at this and you're like, well, yeah, but I have more sophisticated strategy than this. I hear you and I understand what you are saying. All I'm trying to say is this is just like a demonstration of some of the things, pretty amazing things that you can do actually with Python. Yeah. Okay, another strategy is to measure the volatility of an asset. So here I want to know for a particular period how volatile the price is. So typically investors, they don't like volatility, but traders, they like it because if the price is changing, that's an opportunity to make a profit. And one way this indicator could be used, so here let me just clarify it. So here the orange value that you see here, that's the close price of Ethereum. And then the blue line, that's like the 20-day moving average. And then here we have an upper band and the lower band. For some of you who have done statistics, that's like within 2 standard deviations up from the average, which is the MA20. And then this is 2 standard deviations down. And okay, if we get the math stuff out of the way, how can we use this? Well, first it can, if this envelope is wide, that tells us that that's a period where the asset is experiencing high volatility. And you can spot some opportunities. For instance, one thing to think about here, maybe you can buy here at 3,212 when the price touches the lower band. And then when it touches the upper band, maybe you can sell. But this is just one idea. Normally to enter and exit the position, you need multiple confirmations. Okay, So, and here I'm just zooming for the last 100 days. So I'm saying, okay, can I see this it's called Bollinger Band for the last 100 days? Yeah. All right. So now I want to go to start doing a little bit of portfolio analysis. So I am also interested to know how how related these assets are in terms of prices. So because like I remember, one of the things we wanted to do is to pick two of these assets, and the question is, which two should we pick? Should we pick Ethereum and Bitcoin, or Matic and Ethereum, considering that we want to have low risk portfolio? So in that setting, what we do is we take the prices of these three assets. But if you look at the prices, this is like the price of Bitcoin like 1 year ago, and this is the price of Ethereum 1 year ago, and then this is the price of Matic 1 year ago. But the ranges for these prices are pretty wide. Like notice Bitcoin is around, like today is around 60,000, Ethereum is like 3,000, and Matic is around like $1. So it's kind of hard to compare these assets by just looking at the prices. One way that we can do this is we can do a visualization. So excuse me, I'll show you this. Maybe we can zoom in a little bit. Yeah, so with this visualization, you can basically plot the close price of each one asset against the other. And then you can clearly see that like between Ethereum right here and then Bitcoin, you can see there is a correlation, which means basically that when the price of Bitcoin goes up, it seems that also the price of Ethereum goes up. This is on 1 day time frame. They're like here to just explain the rest of this matrix. We usually ignore the diagonal because that's like the correlation of the price against itself, which doesn't really matter to us. We want to look at the relationship between two different assets. So yeah, and so based on this plot, I just want to ask a quick question. And if we want to have a diversified portfolio, which two assets would you pick?
Ethereum and Bitcoin.
Ethereum and Bitcoin. Well, if you see this, Ethereum and Bitcoin, they are highly correlated, right? Which means that when the price of Ethereum goes up, the price of Bitcoin goes up. So that's a happy scenario. We don't mind that. But if you think of the same situation, the other way around, if the price of Ethereum goes down, then that's automatically the price of Bitcoin will go down. So that's going to be really a high risk portfolio. So we actually, if I want to have a diversified portfolio, actually we want to do the opposite of this. We want to look at assets that are least correlated. And visually, you can see this relationship, this one right here, between Bitcoin and Matic. You can see there is a relationship, but it's not very strong. Some people could say, well, I could also maybe talk about this relationship also here between Ethereum and Matic. Well, to kind of conclude this, to put some numbers on this, we can actually use a heat map. So a heat map would give us or provide us with the correlation in terms of numbers. So if it's a positive relationship, it's very strong, the value will be close to 1. If it's like a weaker relationship, it will be close to 0. And again, we ignore the diagonal because that's like the asset against itself. This doesn't count. So from this plot, which correlation is the weakest?
Matic and Bitcoin, I
guess. Yeah, absolutely. You can see here Matic and Bitcoin, it's at 65%. Yeah. So if I want to have a diversified portfolio, probably what I would consider doing is to buy BTC and Matic. But again, I'm not necessarily encouraging you to buy any one of these particular cryptos. I'm just showing you like a method or an approach that you can use to analyze like a basket of assets. You might be interested to compare not just 3 assets, but like 10 of them or 20 of them, and this can be very helpful. Okay, cool. So let's continue the discussion. The other thing we want to look at is the volatility. So sometimes I'm interested to know how volatile certain assets are. So volatility basically means like when the price, like how does the price change? And just to make it a little bit more practical, there are actually websites that you can go to You can, if you go to this website, it basically will sort the cryptos based on their market cap. Notice that as of today, the market cap of Bitcoin is around $1.2 trillion. That's trillion, not billion. And trading volume was for 24 hours was $21 billion. And this is the percentage change. That's what we are calculating. This is for 1 day, and then this is for 7 days. And you can also look at it for shorter periods, like 1 hour. Yeah. Okay. So here what happens is that we are looking at this, what we call the percentage change. And then and then this is basically a histogram, right? That shows the probability distribution. And then essentially when, if all the values are centered around 0, like this is 0%, this is 2.5%, minus 2.5%, this is plus 5%, and so on. So if all the values are centered around 0, that means that for many, many days, here this is the count of the number of days, here on the y-axis, that the price pretty much didn't change. But if you see lots of observations here on the extremes, left or right, that means that there is quite a bit of volatility. So I have a question for you. We are going to use these plots to try to figure out which assets are more volatile. So here we have Matic, Ethereum, and Bitcoin. Can you tell me, based on this plot, which asset is the most volatile?
It's a Bitcoin.
Well, actually, if which color? Maybe let's.
Sorry, falo português. I'm sorry. It's the green Matic.
Yeah, the green color. Yeah, absolutely. Matic is definitely very volatile compared to the other 3 assets, followed probably by Ethereum, and then the least volatile is Bitcoin. So that's another way to look at it, and that's something to look at. You can also do the same thing using what we call the box plot. I'm sure many of you probably have seen this if you've done some statistics. This basically on the for a box plot on the x-axis, that's like usually categorical values. Like I'm trying to compare the age in 3 different countries, for instance. And then here you can see what's like the mean, and then what's the max, and then here what's the median, and then this is like the first percentile, and this is the third one. So basically the idea is when you see like the difference between the first and third percentile, when you see this band is wide, that means the asset is more volatile. And I'm sure some of you are wondering, what are these dots? These are what we call outliers of the distribution. Okay, now what we want to do is we want to answer an important and practical question. Let's say we go back 1 year ago and we invest $1,000 in Bitcoin, $1,000 in Ethereum, and $1,000 in Matic. And I'm interested to know what would be my the value of my investment today. So to be able to do that, we can calculate something called the cumulative return. And that's what we are going to do right here. And basically, what you will see here next is a plot that will show you the cumulative return. So here, like you can think of this, if you invest 1x, how many x's you will get later on. So we said, like we invest $1,000 in Matic. The value of that investment today would be, I don't know, $673. So we would actually lose money. If we invest $1,000 in Ethereum 1 year ago, the value today would be $1,695. And then for Bitcoin, it would be $2,330. So this can be very helpful. You might be interested to look at the return for 1 year or for 1 month or for 1 week. And that can inform your, your trading or investment decisions. And you can do that, again, not just for 3 assets. You can do it like for dozens of them and maybe pick one that has like a high cumulative return for a particular period that you are interested in.
Hi, Ahmed. Sorry to interrupt.
Yeah.
So this cumulative return, right? So
yeah.
How did you do this? I mean, how did you guys do this? Using your own some library, or Python itself is doing it?
Yeah, actually, there is this function. This is in Pandas. There is a data analysis library in Python called Pandas, and there is this function called compound product, this comp prod. Yeah. and that helps you calculate the cumulative return. So basically, you are looking at the price at the end of the period compared to the price at the beginning of the period and calculating the return.
Got it.
Okay.
Thank you.
Sure. The other things also that we could be interested in is like, say, like we are analyzing like some sales data, right? For like an airline, okay? So we can maybe notice for like, you know, the airline industry is a big one here in Dubai, where I am located. And so what happens is I might be interested to know, like, for the price, I understand that over time, the revenue for the airlines maybe has grown. I'm just making an assumption here. It could be a wrong assumption. But let's assume it has grown for the last 20 years. More and more people are taking flights. Okay, so that's a trend. And then I want to know within that, within each year, what's the cycle? I want to know, for instance, like what the sales look like in January and what do they look like in August. And so this, there is this gentleman called Hodrix Prescott. He came up with this filter that helps you to decompose the price into what we call a trend and a cycle. So you can see here the yellow line, that's the actual price, and the blue one, that's the trend, and then the green one here that you see, that's the cyclical part of it. Again, you know, this is something you might be interested in if you are getting into some heavy, you know, pricing analysis, but that's something to just keep in mind. And then last but not least, sometimes I want to look at what we call the candlesticks, yeah? And I know some of you probably already know what the candlesticks are, but just as a review, when I look at a red candle here, what is this point? Like, let's start with the green one. What is this? So this one is the high, this one is the low, and then this one here is the open, and this is the close. So in one day, the open could be at midnight, and then the close would be at 11:59. That's the day for crypto. And then during the day, I can have a high over here and then a low over here. So so this is called like bullish candle. So if it's a bearish candle, basically the high and low, they stay the same. The only difference is that now this one here would be the open, and then this one would be the close. It meant that for that day, the price closed less than what the value of the open was. That's why it's a red candle. Yeah. So this can also be helpful to kind of find out a little bit more information about what's happening in the market. All right, so I am done with the first part of this presentation. I want to just now spend a little bit of time to talk about backtesting. Okay, great. Now let me just go ahead and talk to you a little bit about backtesting. So typically, as if you remember in our discussion, when we were talking about an automated trading system, one of the things also that we need to do, if you remember, these are the steps. So what we did so far is we collected data from an exchange, and then we analyzed the data. That's what we did. We did what we call the exploratory data analysis. And also, but what we haven't done yet is to connect to the broker API. I'm not going to cover that during this session, but what I want to do is I'm going to start with a very simple trading strategy and see how we can backtest it. So I'm going to focus on these two parts right now. And feel free, if you have questions, I'll be happy to take your questions. Okay, so the first thing that we want to do is I like to go ahead and collect data about Bitcoin, again, for the last 1 year. And then I want to be able to define a particular strategy. So again, some of you that are maybe new to trading, this might look a little bit strange, but that's okay. So I'm going to go to Binance, which is one of the largest crypto exchanges. So here I'm going to pick up or select an indicator called the RSI, which is a price called the relative strength index. So it tells us, like, for a given period of time, whether an asset is overbought or oversold. So this is the indicator right here. So it's a mathematical indicator, and you can feel free to learn more about it. Basically, there are two values for the RSI, 30 and 70. These are thresholds. So if the price is below 30, right here, you can see it's below 30, we say that the asset is oversold, which means that it's reasonably priced. Maybe that's a good time to buy it. Notice right here, Bitcoin was around $25,000 or $26,000. And then if it's above 70, you can see here, or we can even see this point right here, that's $32,000. Okay, so we can look at this strategy and we can say, okay, great. What we want to do is we want to apply this strategy and we want to see how well it performs, right? For a whole period of time, because the alternative to automating this is that you need to keep monitoring this yourself and make a decision when maybe the RSI is lower than 30, then you buy, and if it's above 70, then you sell. But that's not fun, and currently what happens is that over 70 or 80% of the trading is automated. So if you want to do it manually, you will be competing against trading bots, which is, I don't think it's a good idea. But if we want to automate this, the first step that we need to take is to say, well, before we deploy this strategy live in production, let's go ahead and test it against historical data. So we collected data about Bitcoin, and then here we are calculating the indicator, the RSI. And we are saying, okay, my entries for this 1 year would be when the RSI is below 30, and I will exit when it's above 70. Yeah, and then I will conduct an analysis. So here, this is called backtesting. So here we are backtesting this for a period of 365 days. And notice that what it gave us for a whole year is a return of 14%. Yeah, that's basically what this backtest told us. Now, for some people, this looks like, okay, that sounds okay, but can we do better? So one way that we can improve this strategy is we can just basically ask a question: how do we know that 30 is the best entry point? And how do we know that 70 is the best entry point? So that's why we use like a backtesting framework like this one that will enable us to sample values for the entry and exit. So here what I'm going to do is I'm going to sample 10 values for the entry from 1 to 45. Okay, from 1 to 45, we're going to sample 10 values for the entry, and for the exit, we're going to sample 10 values from 55 to 99. And then what I'm looking for is the most profitable combination between the entry and the exit. Okay, so let's go ahead and do that. So this is where we actually optimize the strategy. So, okay, so if I look at this right now, basically what this is telling me right here, if you look at this chart, so X, that would be the entry, Y, that would be the exit, and then Z, that's like the return that I would be getting. So for an entry of 45 and an exit of 99, I'll be getting 134% return. So that's a very significant compared to what we had earlier. So that's the kind of insight that you can get from backtesting. Of course, if a strategy does very well on historical data, doesn't mean that it will continue to do well on future data, but at least it will give you some insight. Yeah. Okay, and then finally, just like one more idea that I want to share before I go is this idea that you can tune so here you can create actually custom indicators, and this is where we get into more advanced part of the course, where you can actually create your own custom indicators, and then you can play with whole range of values. So notice here that let me just show you one that's even more, yeah, this one here. So I'm saying, okay, I want to try this strategy for the RSI window, which is like the period that we use to calculate the RSI. So we're going to go from 10 to 40 with the step of 3. The MA window, which is the moving average, we're going to go from 20 to 200 with the step of 15. And then the RSI entry from 10 to 40 with the step of 4. And then the exit from 60 to 85 with the step. So this is vectorized, where you're giving the backtesting framework huge number of values to play with. and I'm looking for the perfect combination. And I just ran this test before you guys came online. And then basically, and they did this for 3 assets. Here we were trying to test, I looked at, this is one period for, I believe, 1 day. And they said, what's the total return that I was able to get? And yeah, so here I have 2%. That's the max return. And then it provided me with the values that will give me the max return. So for instance, this is the RSI window. This is the this is called the exponential moving average window, and then the RSI, and then basically that's the return that I'll be able to get. So I showed you this to just demonstrate that you can backtest multiple symbols or multiple assets with multiple indicators and try to find the combination that can provide you with the best return. So that's called the hyperparameter tuning. Okay, so I am done with this section. Are there any questions or comments?
So, hi, Ahmad Venkat here.
Yeah, hi.
When you said backtesting, like what and all, like, can you please explain it a little bit, please?
Yeah, so backtesting is this idea that, so think of like an investment strategy or trading strategy that you have. So you're thinking maybe like when the price reaches a certain level, okay, I'm going to buy at this point, and then if it reaches another level, you will sell. And so if you don't do backtesting, then you can go and invest your money, and you could, you know, you could make money, which is good, or you could lose money. So an approach, backtesting, is a simulation. You can think of it as a simulation. You can say, this strategy that I'm thinking of, let me run it against historical data and see how it performs. So if it doesn't do very well for the last week data, well, I would be, you know, cautious about, you know, that using that strategy for real life or live trading. So that's the idea. But if it seems to do really very well, then it gives me some level of confidence that, you know, if I use it for maybe the next few days, it will do well. It will be profitable.
You all did like using the Python language itself, or like you guys have your own framework or something where you guys were using or something like that?
Well, I mean, like all the frameworks and libraries that I've showed you here and that we teach in the course, they are all available and open source, right? So that's the thing. And then finally, I just wanted, for some of you who are looking at this, I wanted to show you, this is this is the bot that I've developed that's running actually live. So here I have a strategy. I am calling it market edge strategy. So basically it's constantly monitoring the market and looking for an opportunity to enter or exit. For instance, here you can say do nothing. In other words, it's not going to do anything at the moment. So, but when the proper conditions are fulfilled, then it will go ahead and execute an order automatically. And again, when the profit is achieved, then it will close the position. So that's an example of a live bot that's running. I know the user interface is not the best, but at least hopefully it can give you some ideas.
You can apply this on in any market. Like currently we are talking the scenario of crypto. For example, if take an example of US market or stock rather than crypto.
Right.
So we can do that, is it?
Yeah. So basically, if you that's an excellent question, and I appreciate it. So if you build an automated trading system, which using a particular strategy with an exchange, really the only thing that you need to change is one component of that trading system, which is called the broker. You know, you could connect to, like, so if you are, so different brokers, or like we call them exchanges, they would normally provide you different APIs. So let's say you want to trade US stocks and eToro or any of the platforms, they would provide you like an API in Python. Many of them, they provide it in Python that you can use to connect with their exchange to, you know, to buy and sell either stocks or any assets that you are interested in. So if you build a bot or a trade, we call it a bot, but what I mean by that is a trading system, or can also be an investment system. automated one, the main component that you will change in this setting is the broker component that you will use to connect to different exchanges, if that makes sense.
Yeah, thank you.
Yeah, sure. So like, I just want to maybe just make a couple more comments. Why would we care about this? Well, like, you know, financial industry is huge. Certainly here in Dubai, where I'm located, we have the international Dubai DIFC, or Dubai International Financial Center. So it's a financial hub. And what's really cool about the financial markets in general is that, again, accessibility to data. You can get as much data as you want for free, and you can use some very powerful tools to analyze it and make some, hopefully, some good decisions. And that's what one of the things that's encouraging about it. So even if you are interested in AI or data science or machine learning, one of the requirements for any of these areas is to have access to large amount of data, and with financial markets, crypto, or even forex, you can get lots and lots of data for free. So that's one of the encouraging parts about it. And also with respect to trading, as I mentioned, like a huge percentage of the trading that's done today is done in an automated way. So if you want to learn this or learn how to do this, what is the learning path? And I just want to share with you a couple of programs that have been extremely successful that we have. Well, if you already know Python or some programming, we have a course called Algorithmic Trading and Financial Data Analysis with Python. It's accredited by the Dubai government. And basically, it will teach you how to build an automated trading system from A to Z, starting with what we did, like collecting historical data, analyzing it, building a trading strategy, backtesting it, automating your trades with a live exchange, creating your trading bot, and then deploying it on the cloud, and then then analyzing the performance of your bot. And so this has been like one of the top programs that we have. If you don't know Python, then I would recommend taking our AI professional program, which basically will cover the foundations of Python. So if you scroll down, so this covers the foundations of Python, object-oriented programming in Python, data analysis, data visualization. It also covers machine learning, and it even covers deep learning. Yeah. So these are some of the best programs that I would recommend.